Okay, so let's get into it.
Yeah.
We're diving into these sources today that focus on real-time financial data. And for a lot of us, I think, when you look at an intraday trading chart, you know, all those blinking lights, the red and green candles,
Yeah.
it just feels like chaos.
It really does, or at best, a complete emotional roller coaster.
Exactly.
And, the mission of this deep dive is to show you a system that really tackles that chaos head on. Our sources detail this specific analytical framework, and it's designed to convert all those complex moment-to-moment price movements into, well, what they call structured, explainable intelligence.
And I think it's important to say up front, we aren't interested in making predictions here. That's not the point. The whole goal of this architecture is to impose objectivity.
Right.
It's built around 4 core ideas: structure, state validation, continuity assessment, and then this contextual visualization. It's really about giving you a precise map of where the market is, not where you hope it's going.
And because the mechanics can get a little detailed, let's establish our core analogy right away. I think it helps. I imagine this entire 4-component framework as, say, the flight navigation system on a commercial airliner.
Ooh, I like that.
Every single layer provides the pilot, so you, the learner, with essential data, non-discretionary data. It tells you the fixed route, the current flight status, and the immediate weather ahead.
That definitely makes the complexity feel more accessible. Okay, so let's unpack this navigation system. It's a framework built on 4 distinct components. And it's not just a collection of tools, right? They have to operate in a strict sequential order. So the output of layer 1 feeds into layer 2 and so on.
Precisely. That sequential integration is what makes the analysis so robust. It takes that raw price action and it grounds it in structural logic. And if we use our flight analogy to map out the 4 layers in order.
Okay, so layer 1 is the opening structure. That's our pre-flight plan, the fixed boundaries of the expected route.
Exactly. Then layer 2 is the bias table. This acts as the autopilot status display. Are we climbing, are we cruising, or are we in a confirmed descent?
And layer 3 brings in the retracement signal. So those are the sensors that can tell the difference between, say, minor turbulence and a genuine, sustained loss of altitude.
Perfect. And finally, layer 4 is the red and green clouds. This is your weather radar. It converts all that underlying analysis into a simple, immediate visual context.
That's a great structure. Let's start with that foundation then. Components 1 and 2. These are the layers that establish the fixed market structure and then classify its current state. So component 1, the pivot, support, and resistance-based opening structure.
The key word here is objective. Before the session even begins, the system uses historical data and these established structural levels, pivots, supports, resistances, to define a predicted opening range.
How exactly does it determine those fixed boundaries before the session starts? I mean, is it purely historical data, or is there some kind of predictive layer mixed in?
No, the sources confirm this is all about fixing the battlefield ahead of time. It relies on established daily or weekly structural levels, which ensures the levels themselves are just non-negotiable references. The entire purpose is to evaluate that early price behavior relative to these fixed boundaries.
And what's the core insight we're looking for there in that opening phase?
You're looking for acceptance or rejection. So, for instance, if a price gap's way up, the emotional reaction for most people is go long.
Of course.
But this system forces you to wait. Does the price actually accept that higher value zone and stay above the resistance level? Or does it immediately reject it and start sliding back down? This gives you early clarity and it prevents you from getting manipulated by just the gap direction alone.
Okay, so we've set the boundaries. But now we need to know what the market state is within those boundaries. And that takes us right into component 2, the bias table-driven market state classification. We need to classify the behavior into bullish, neutral, or bearish.
And this is where the system's rules-based approach really shines. The classification isn't subjective at all. It's determined by a dynamic numerical representation. They call it the bias score.
The bias score.
Yeah, and this score is your real-time market barometer. It gives you a number like plus 15 for strong bullish, or maybe next 11 for bearish.
Tell us a bit more about the mechanics of that score. If it's updating dynamically, I mean, what stops it from just telling you what you already saw happen a minute ago?
That is the most critical technical detail. The score is explicitly non-repainting. And for any listener who might not be familiar with that term, a lot of indicators can repaint,
Right.
which means that after a candle closes, the indicator might retroactively adjust its position on a previous candle. So it looks perfect in hindsight, but it was useless in real time.
Ah, So non-repainting is crucial for trust. If it doesn't adjust its past reading, you know the signal you saw 5 minutes ago was genuine and reliable when it happened.
Exactly. It just eliminates that hindsight bias completely. The score updates based on 3 integrated factors: how the price is interacting with those fixed pivots and ranges we just talked about, the depth and sequence of any retracement behavior, and then the overall structural alignment. Is the price just continuously failing to reclaim key levels?
So it's a state confirmation layer.
Yes, it ensures you don't misclassify, say, a minor temporary pullback as a genuine trend reversal.
But I have to ask, if the system relies so heavily on those predefined structural levels, that pre-flight plan, what happens if there's a major black swan event or some sudden news that just completely invalidates the planned structure immediately? Does this system break down?
That's a great question, and it really speaks to the framework's resilience. The system doesn't break, it reports the immediate structural failure. If some massive news event causes the price to just crash straight through all 3 support levels in a single candle, the bias score will transition almost instantly to strong bearish, maybe a -20, because the price interaction metrics have violently shifted. The system prioritizes the rules of structural integrity over the expectation from the pre-plan. It tells you the plan is now null and void, and here is the new confirmed state.
That makes a lot of sense. So it's designed to embrace change, but only once the structural rules have confirmed it. Okay, let's move on to component 3, which is all about validating that change retracement signals and structural continuity analysis.
This is where we validate the state that the bias table gave us. If the bias table says we are descending, we need to check the sensors. Is the plane just experiencing some minor turbulence, a healthy corrective pullback, or are we truly losing altitude because we can't recover?
So how does the system quantify that difference?
The retracement markers track the depth, the sequence, and the interaction with support levels. A healthy pullback, it holds a previous minor support level, and it immediately bounces to continue the trend. But true trend continuation, that's confirmed when 2 things happen. First, the retracement sequences escalate progressively. They get deeper, more sustained. And second, the price consistently fails to reclaim structure after a pullback. If it just keeps bumping its head on resistance, the path of descent is validated.
So if the market is failing to reclaim that structure, you know you need to stick with the primary direction confirmed by the bias score. That continuity awareness that really reduces those frustrating false reversal assumptions that can trap an emotionally driven trader.
It delivers certainty. And finally, we package all of that intelligence into component 4, the red and green cloud formation. This is our weather radar, the high-level visual context.
Visually, it's simple. Green clouds mean sustained positive structural alignment, and red clouds mean sustained negative structural alignment.
And the simplicity is the whole goal, but it's so critical to understand the mechanism. These clouds are the output of all the deep analysis. They are not discretionary.
Right, they're not a signal in themselves.
No. Their transitions are strictly determined by the objective rules from the preceding layers. The bias state, the pivot interactions, the retracement validation. They don't generate the signal, they just display the consensus.
They convert the consensus of all that complex data, the bias score, the failed retracements, into a single, easily interpretable visual confirmation. Situational awareness at a glance.
Exactly. You don't have to check 4 separate things. You can just see immediately that the rules-based approach confirms bearish control is dominant or vice versa.
Okay, let's bring this whole system to life now by seeing it in action. The sources gave us a fantastic case study based on the intraday analysis from December 24th, 2025. And this date focused on 5-minute charts for 2 specific markets: the Japanese stock 7203 and the South Korean stock 005930.
This scenario is perfect because it sets an emotional trap right at the open. So let's walk through the sequence of events and see how the 4 layers collaborated to generate the correct read.
All right, step 1, the opening structure outcome. So both stocks, 7203 and 005930, they opened with these large, enthusiastic gap-ups.
Right, the emotional hook.
Everyone sees the gap and thinks launch.
But layer 1, the opening structure, it immediately signaled caution. Despite that big gap up, the price action failed to sustain above their predefined pivot and resistance levels. That immediate rejection of the higher structural zone, that pre-flight plan, was the first critical sign of weakness.
So structure trumps the visual gap.
Every single time.
Okay, so the preset structure told us, don't trust the opening enthusiasm.
Yeah.
What happened next as the price started to stall and drop?
Well, that's where layer 2, the bias table, stepped in. The score quickly transitioned from, a neutral or maybe slightly positive state to a negative one. For 7203, we saw it register a bearish score of -11 during the slide. So the system classified the market state as bearish, confirming the failure we saw in the opening structure.
The autopilot was now locked onto a confirmed descent path.
Exactly.
But the market often has these temporary bounces. How did Layer 3, the retracement signals, prove this wasn't just a brief dip before a real rally?
Validation is everything. When the prices tried to bounce to correct, the retracement sequences just escalated progressively. They weren't sharp, healthy bounces. They were getting deeper and deeper. And crucially, every single attempt to reclaim that initial structure failed consistently. This proved that these movements weren't corrective recoveries. They were part of a genuine, sustained, bearish continuation. The continuity was validated.
That sequence is fascinating. Structural rejection led to the state classification, which was then validated by the price behavior. And finally, Layer 4, the red and green clouds, provided the summary.
And the outcome was the ultimate reinforcement. Red cloud dominance persisted throughout the entire session in both of those stocks. The visual layer just consistently reinforced the analysis of the first three layers, confirming sustained bearish control. You had clarity and context from the open all the way to the close.
So the ultimate insight here is that the system, it provided an early context, that structural failure despite the gap. It classified the state as bearish bias, it validated the continuity with those escalating retracements, and then it visualized the result with the red cloud dominance. It really abstracts the chaotic nature of those 5-minute candles into an objective, interpretable conclusion.
It takes the subjective right out of the decision process. The value of this entire framework isn't just in recognizing what the market is doing, which is just price fluctuating. It's in identifying why that movement matters by grounding every single decision cue in objective, rules-based structural analysis. It tells you if the foundation is sound or if it's collapsing.
And that grounding in structural integrity, that concept of constantly validating continuity against predetermined levels, it has relevance far beyond just a trading chart. If knowing whether a trend is genuine continuation versus just a temporary pullback is the key to managing financial risk, how might you apply this layered approach to your own complex projects?
Maybe in analyzing the long-term health of a multi-year development project, or tracking whether a recent dip in sales is just market turbulence or a structural, sustained shift in consumer behavior. That is something for you to mull over as you transition from this deep dive back into your day.